Okay, I need to start this video with a disclaimer. When I told people I was making a video about who can afford a $100,000 house in 2026, I got one of three reactions. The first reaction was genuine excitement. Oh my gosh, those still exist? The second was deep skepticism. $100,000 in this economy? Are we talking about a shed? And the third, which came mostly from people who live in major coastal cities, was outright laughter. Actual, genuine, nose exhale laughter. Because the idea of a $100,000 house to someone paying $3,200 per month for a one-bedroom apartment in San Francisco sounds approximately as realistic as a unicorn with a good credit score. And yet, and this is the part that will either excite you or deeply complicate your worldview, $100,000 homes are real. They exist. They are listed on Zillow right now as you are watching this video. You can buy them. Some of them have multiple bedrooms, some of them have yards, some of them have more square footage than you currently rent for twice the price in a city where everyone is perpetually one rent increase away from an existential crisis. But here's the question that actually matters. The one this video is going to spend the next hour answering with complete, unflinching, slightly uncomfortable honesty. Who can actually afford one? Not who can find one, we'll cover where they are, but who, given their income, their debt, their credit score, their employment situation, their family size, and the full cost of homeownership beyond the sticker price, can genuinely, sustainably, comfortably afford to buy and own a $100,000 house in 2026. Because affordability, it turns out, is a significantly more complicated question than, do I have enough for a down payment? Affordability involves the mortgage, the interest rate, the property taxes, the insurance, which in some states has turned into its own financial horror movie, the maintenance, the repairs, the hidden costs that every experienced homeowner knows about and every first-time buyer discovers approximately 3 weeks after closing when something breaks and the warranty doesn't cover it. We are going to cover all of it, where these homes actually are, what the income requirements look like, what the catch is, and there's always a catch, who specifically is positioned to make this work, and who, despite desperately wanting it to work, is looking at a $100,000 house and doing math that simply doesn't add up, no matter how many times you run it. Let's start at the beginning. Let's start with the number itself and what it means in the context of the 2026 American housing market. Chapter 1. The $100,000 house in context. A number that means very different things in very different places. Before we can talk about who can afford a $100,000 house, we need to establish something fundamental, what a $100,000 house actually is in 2026, because the answer to that question varies so wildly depending on where in America you're standing that it basically constitutes two entirely different conversations. The median home price in the US was $419,200 in the last 3 months of 2024 and is projected to rise to $426,000 by the second quarter of 2026. Empower. Let that number sit there for a moment. The median, not the fancy home, not the luxury property, the middle of the market, $426,000, which means that a $100,000 house isn't just affordable, it's a full 76% below the national median price. Finding one is like finding a sale that's more than 3/4 off at a store where everything was already pretty expensive. In most of America's major metropolitan areas, a $100,000 property listing is either a parking space, a storage unit, a timeshare that someone is desperately trying to unload, or, most commonly, simply non-existent. In Los Angeles, there are currently 13 homes for sale under $100,000 in the entire city, bank rate, and if you click on those listings, you will discover that most of them are mobile homes in parks where you rent the land beneath them, or condominiums with HOA fees that cost more per month than a mortgage would in Ohio. In New York, San Francisco, Seattle, Boston, Miami, the number is similarly tiny and similarly deceptive. But here's where the story gets genuinely interesting. Move inland. Move to the places that don't make the cover of real estate magazines. Move to the parts of America that the coastal discourse tends to skip over on the way to discussing whether avocado toast is responsible for the housing crisis. And suddenly, $100,000 is not a punchline. It is a down payment on a decent life. Decatur, Illinois ranks number 1 in U.S. News 2025 to 2026 Best Affordable Places to Live. The median home value there is about $89,855, among the lowest for mid-sized metros. Empower read that again. The median home value, not the cheapest. Available listing. The middle of the market, below $90,000, in a city with a real population, real employers, real amenities, and a cost of living that is, according to the same data, about 90% of the national average. Decatur is not a ghost town. It is not a post-apocalyptic wasteland. It is a Midwestern city where the math of homeownership actually works, which in 2026 puts it in a category of American places that is rarer than it used to be and more precious than it gets credit for. Granite City, Illinois is projected to have one of the lowest median home prices in the nation for 2026, setting the bar at an astonishing $119,000 carry. And while we're in Illinois, a state that doesn't get nearly enough credit for its affordable housing markets, Rochester, New York has been called the #1 market for first-time buyers, with median listing prices hovering around $139,900. Carrie, these aren't the cheapest individual listings in the country. These are median prices. The prices at which half the market sits above and half sits below, which means homes well under $100,000 exist in these markets in meaningful numbers. The geographic distribution of affordable housing in America in 2026 follows a pattern that is simultaneously obvious and underappreciated. The cheapest places to buy a house in 2026 are largely concentrated in the friendly Midwest and South, where the cost of land remains reasonable and steady population growth means these areas are far from stagnant. Carry the Rust Belt, the agricultural Midwest, the rural and small city South, the Appalachian region. These are the zip codes where $100,000 buys something real. And what does something real look like at $100,000? In Detroit, for under $100,000, you can get a charming 3-bedroom, 2-bathroom house with a yard, something that would cost a fortune in other cities. In Cleveland, you can find century-old brick homes with hardwood floors, large windows, and backyards with 3 or more bedrooms for less than $100,000. In Birmingham, Alabama, $100,000 can land you a charming single-family home with a big backyard in neighborhoods like West End and Ensley, credible 3 bedrooms, 2 bathrooms, a yard, a backyard, hardwood floors, for $100,000 in American cities with real infrastructure, real history, and real communities. The homes may need some work. We'll get to the catch shortly because there is always a catch, but they exist, they are purchasable, and the mortgage payment on a $100,000 home is, by any mathematical measure, dramatically more manageable than the rent on a comparable space in the coastal markets where most housing discourse is centered. This is the fundamental context for everything that follows. The $100,000 house is not a fantasy. It is not a historical artifact. It is a real thing available in specific geographies with real trade-offs to buyers who meet certain financial criteria. The question is who meets those criteria, and the answer is more nuanced than either anyone can do it or it's impossible. Chapter 2. The Mortgage Math. What $100,000 actually costs you every month. Let's do what most housing content studiously avoids doing, the actual math, not the aspirational math, not the back-of-the-envelope estimate, the real line-by-line, this is what shows up in your bank account every month math. Because the sticker price of a house and the actual monthly cost of owning it are 2 very different numbers, and the gap between them is where a lot of first-time homebuyers get their first very expensive education. Start with the mortgage itself. On a $100,000 home purchase with a 20% down payment, $20,000, you're financing $80,000. At the current mortgage rate environment, where 30-year fixed rates have been hovering in the 6% to 7% range through late 2025 and into 2026, let's use 6.5% as a working number. At 6.5% over 30 years, the monthly principal and interest. Payment on an $80,000 loan is approximately $506 per month. $506 per month for a mortgage in 2026. I want you to sit with that number for a moment, especially if you're currently paying $1,800 to $3,000 per month in rent. The mortgage payment on a $100,000 home with a standard down payment is lower than the monthly cost of renting a one-bedroom apartment in almost every major American city. This is the mathematical core of why affordable housing markets matter, not as a consolation prize for people who couldn't make it in competitive markets, but as a genuinely viable financial strategy that many people haven't seriously considered. But, and this is a very significant but, the mortgage payment is not the total cost of homeownership. It is a starting point from which several additional costs are added, and some of those additions are substantial enough to change the affordability calculation significantly. A $100,000 mortgage comes with a monthly payment of principal, interest, taxes, and insurance of around $840, assuming a 6.5% interest rate and a 30-year term. Carry. So the all-in monthly cost, when you include property taxes and homeowner's insurance, is approximately $840 per month on a $100,000 mortgage, which is still remarkably low by national standards, but is meaningfully higher than the $506 principal and interest figure. Property taxes are the first significant addition, and they vary enormously by location, which matters quite a lot since the affordable markets where $100,000 homes exist tend to have their own property tax profiles. In Illinois, property taxes are notoriously high relative to the property values. One of the reasons homes are so cheap to buy there is partly offset by the ongoing cost of owning them. Illinois has one of the highest effective property tax rates in the country, running around 2% of assessed value annually. On a $100,000 home, that's $2,000 per year, or $167 per month. In property taxes alone, Michigan and Ohio have lower rates, typically in the 1 to 1.5% range. Alabama and Mississippi are lower still, sometimes below 0.5%. The geography of your affordable home determines how much property tax adjusts your monthly payment. Homeowner's insurance is the second addition, and in 2026 it is a considerably more fraught calculation than it was even 5 years ago. The insurance crisis, driven by climate-related losses, reinsurer withdrawals from high-risk markets, and general market disruption, has made some previously affordable insurance markets dramatically more expensive. Florida homeowners insurance in particular has become something approaching a financial disaster in certain counties, with annual premiums that can rival or exceed the mortgage payment itself. In the Midwest and most of the South outside of coastal areas, insurance is more manageable. Typically $800 to $1,500 per year on a $100,000 home, or $67 to $125 per month. Then, there's the question of private mortgage insurance, or PMI. If you put less than 20% down, which means a down payment of less than $20,000 on a $100,000 home, you'll typically pay PMI until you've built 20% equity. On a $100,000 home, PMI runs roughly $50 to $100 per month. It's not enormous, but it's an additional cost to factor in, and it disappears once you've built enough equity, which is cold comfort in the short term. Without other debts, you generally need to earn at least around $28,000 to $29,000 per year to qualify for a $100,000 mortgage, carry $28,000 per year, the federal minimum wage at $7.25 per hour for 40 hours per week for 52 weeks, produces $15,080 per year. Not enough. But minimum wage in many states is now $12, $14, or $15 per hour, which produces $24,960 to $31,200 per year at full-time hours. At the higher end of those state minimums, you're approaching the income threshold for a $100,000 mortgage qualification, which is remarkable and also sobering in equal measure. This is the first major finding about who can afford a $100,000 house. The income bar, while real, is substantially lower than most people assume. You do not need to be a high earner. You do not need a six-figure salary. You need a stable income in roughly the $28,000 to $35,000 range, assuming minimal existing debt, to qualify for the mortgage. What you do need is the down payment, a reasonable credit score, and a location strategy that takes you to where these homes actually exist. Chapter 3. The Down Payment Problem. the biggest barrier that isn't the mortgage. Here's where the affordability conversation gets genuinely complicated for a lot of people, and where the gap between technically qualifies and actually able to do this becomes most visible. The down payment. On a $100,000 home, a 20% down payment is $20,000. A 10% down payment is $10,000. Even the minimum 3.5% FHA down payment is $3,500. These numbers are dramatically smaller than the down payments required in expensive markets, where 20% of a $500,000 home is $100,000, a number that takes most people a decade or more to accumulate. On a $100,000 home, the down payment math is genuinely accessible, but accessible and already saved are different things, and for a significant portion of the population that would theoretically benefit most from affordable housing markets, people who are currently renting at high cost in expensive cities, paying off student loans, managing credit card debt, and struggling to build any meaningful savings, even $3,500 to $20,000 in liquid savings can be a genuine challenge. The median savings balance of Americans under 35 is approximately $5,400, which sounds like enough for a 5 to 10% down payment on a $100,000 home. And it is, barely, but that $5,400 also has to cover closing costs, which on a $100,000 home typically run $2,000 to $5,000, and it has to leave some reserve for immediate repairs and maintenance after purchase, which is not optional. It is the financial buffer that stands between you and a crisis the first time the water heater gives out. In practice, a buyer targeting a $100,000 home should have $8,000 to $15,000 in savings before closing, enough for a meaningful down payment, closing costs, and a basic emergency reserve. For buyers who don't have that amount saved yet, the good news is that there are specific programs designed to close the gap. FHA loans require a minimum 3.5% down payment, $3,500 on a $100,000 home, and have more flexible credit requirements than conventional loans. Many states have first-time homebuyer programs that offer down payment assistance grants or low-interest loans specifically to help buyers in lower price ranges. USDA loans, which apply in rural and some semi-rural areas, require zero down payment for qualifying borrowers in qualifying geographies. VA loans for veterans and active military also require no down payment and no PMI. These programs exist specifically because policymakers have recognized that the down payment is the biggest single barrier to home ownership for lower-income buyers. And in the $100,000 price range, they can genuinely bridge the gap for buyers who have the income to qualify for the mortgage but haven't accumulated a large down payment. The catch, there's always a catch, and we'll keep coming back to this, is that these programs have geographic and income restrictions, and the application process can be slow and paperwork intensive in ways that disadvantage buyers in competitive markets. Chapter 4. Where $100,000 homes actually exist, the geography of affordable America. Let's get specific, because affordable housing exists in the Midwest and South is a true but extremely vague statement, and this video is not about vague statements. Let's talk about actual places with actual data where $100,000 buys an actual house in 2026. The key thing to understand about the geography of affordable housing is that it doesn't follow the logic of popular real estate discourse. The places where $100,000 homes are abundant are not necessarily declining, depressed, or unlivable, though some of them have challenges we'll address honestly. Many of them are stable, functioning communities with real local economies, real amenities, and real quality of life that differs from coastal norms in ways that some people find liberating and others find limiting. The Midwest, where the MathWorks Decatur, Illinois, ranks number 1 in U.S. News 2025 to 2026 Best Affordable Places to Live, with median home values around $89,855 and a cost of living that's 90% of the national average. Empower Decatur is a manufacturing and agriculture hub of about 70,000 people. It has hospitals, it has schools, it has grocery stores and restaurants and all the infrastructure of normal American civic life. What it doesn't have is a hot job market in tech or finance, which is why the housing market never got expensive, and why a remote worker with a laptop and a decent internet connection might find it genuinely attractive. Granite City, Illinois, is projected to have a median home price of around $119,000 in 2026, carry with individual listings well under $100,000 available in meaningful numbers. Granite City is in the St. Louis metro area, which means you get a Midwestern city's affordability with proximity to a major metropolitan area's employment, healthcare, culture, and airport access. This combination, affordable housing within a reasonable commute or drive of a major metro, is one of the more underappreciated value propositions in the American housing market. Cleveland, Ohio offers century-old brick homes with hardwood floors and large windows, with 3 or more bedrooms for less than $100,000 in areas like Collinwood and Old Brooklyn. Credible Cleveland is a genuinely interesting case study in the $100,000 housing conversation because it's a real city with professional sports teams, a world-class art scene anchored by the Cleveland Museum of Art and the Rock and Roll Hall of Fame, major employers in healthcare and education, and a downtown that has seen meaningful revitalization over the past decade, where the housing market is still priced for people earning normal wages. Detroit offers charming 3-bedroom, 2-bathroom houses with yards in neighborhoods like Morningside and Bagley for under $100,000. Credible and the city's narrative has shifted meaningfully in recent years, from cautionary tale to genuine revitalization story. Downtown Detroit is attracting businesses and young professionals. The arts community is thriving. The food scene has genuinely improved. And the housing market, while no longer as dramatically cheap as it was at the bottom of the post-bankruptcy era, still offers more square footage per dollar than almost anywhere else in the country. Peoria, Illinois, offers 2 to 3 bedroom houses in neighborhoods like East Bluff for under $100,000, credible with the small to mid-sized city combination of community feel and functional amenities. Rolla, Missouri, home to Missouri University of Science and Technology, offers 2 and 3 bedroom homes under $100,000 with the particular advantages of a college town: cultural programming, educated neighbors, and an economy anchored by an institution that isn't going anywhere. The South, warmth, culture, and cheap real estate. Birmingham, Alabama, offers charming single-family homes with big backyards in neighborhoods like West End and Ensley for $100,000, credible with the caveat that these homes may need some updating. Birmingham is a city that has been chronically underrated in national real estate conversation. It has a growing food and culture scene, multiple universities and major employers, a cost of living that is dramatically below the national average, and a housing market that remains genuinely accessible to people earning modest incomes. Pine Bluff, Arkansas offers some of the most affordable real estate in the South, with comfortable homes in quiet neighborhoods like West End or Dollarway for under $100,000. Credible Pine Bluff is a smaller city, about 40,000 people, that is genuinely inexpensive across all cost categories, not just housing. If your financial goal is maximum purchasing power per dollar of income, Pine Bluff and similar small Arkansas cities represent the extreme end of that spectrum. Mississippi consistently ranks among the most affordable states for housing, with median prices well below the national average and a meaningful supply of homes under $100,000 in its small cities and rural communities. The trade-off, and we'll keep coming back to trade-offs because they're real, is that Mississippi's median household income is also among the lowest in the country, which means the housing is cheap, partly because the economic opportunity is limited. The Appalachian Corridor, scenery, affordability, and complexity. Southwest Virginia, Eastern Kentucky, Western North Carolina, and West Virginia all have meaningful inventories of homes under $100,000, often in strikingly beautiful rural and small-town settings with mountain views and outdoor recreation access that would command enormous premiums in other markets. In Southwest Virginia, there are homes available for under $100,000 nestled in the mountains close to outdoor activities like hiking and fishing. Freedom for all Americans. The Appalachian housing market is particularly interesting for remote workers, people whose income is tied to a coastal or national employer but whose physical location is flexible, because it offers the combination of very low housing costs and genuinely high natural beauty that is difficult to find anywhere else in the country. The challenges in this region are real. Internet infrastructure in rural areas can be Spotty healthcare access in some communities is limited, and the regional economy has faced significant structural challenges over decades. But for the right buyer, particularly a remote worker who values natural setting and low cost above urban amenity, Appalachian housing markets offer something genuinely unusual. Chapter 5: The Credit Score Question. The Invisible Gatekeeper. Here's one of the most important and most frequently underestimated factors in the $100,000 home affordability question: your credit score. Because a $100,000 home with a bad credit score can be significantly more expensive on a monthly basis than a $100,000 home with a good credit score. So much so that the credit score can be the difference between a payment that's manageable and one that's a stretch. The mechanism is simple. Your credit score determines the interest rate your lender offers you. And the interest rate on any mortgage, even a relatively small one, has an enormous effect on the total cost of the loan over 30 years. At 6.5% interest on an $80,000 loan, 80% of a $100,000 purchase price, the monthly principal and interest payment is $506. Over 30 years, you'll pay approximately $182,000 in total, $80,000 in principal and $102,000 in interest. The interest costs more than the loan itself. This is normal, expected, and depressing in exactly equal measure. Now bump the interest rate to 8%, which is what a borrower with poor credit might be offered in the current rate environment. The monthly payment on the same $80,000 loan rises to $587, an $81 per month difference. Over 30 years, you pay $211,000 total. The higher interest rate costs you an additional $29,000 over the life of the loan on a $100,000 home, just because your credit score was in a different range. For FHA loans, which are the most common path to home ownership for buyers with lower credit scores, the minimum qualifying score is 580 for a 3.5% down payment or 500 with a 10% down payment. Conventional loans typically want 620 or higher, but qualifying is different from getting a good rate, and the difference between a 580 credit score and a 740 credit score can be a full percentage point or more in the interest rate offered, which over 30 years and even on a modest loan is a significant amount of money. The credit score is, for many potential buyers in the $100,000 price range, the gatekeeper that sits between "I earn enough to qualify for this mortgage" and "I can actually get approved at a rate that makes this work." And improving a credit score, while achievable, takes time. It requires paying down existing revolving debt, maintaining perfect payment history, avoiding new hard inquiries, and waiting for negative marks to age off the report. For someone with fair credit who is seriously pursuing a home purchase in an affordable market, spending 12 to 24 months aggressively improving their credit score before applying can save thousands of dollars over the life of the loan. The specific credit actions that matter most in this price range: getting all existing accounts current if any are past due, paying down credit card balances to below 30% of credit limits, and avoiding opening new credit accounts in the 6 months before applying for a mortgage. These are not complicated actions. They are not secret knowledge. They are the standard advice that credit counselors and mortgage brokers give every day, but executing them consistently over the months required to see meaningful score improvement takes the kind of patient financial discipline that is easier to describe than to sustain. Chapter 6: The Hidden Costs That Nobody Warns You About. Here's where we have to have a very honest conversation, the kind that real estate agents sometimes gloss over in their enthusiasm to get to the closing table, and that first-time homebuyers sometimes filter out in their excitement about becoming homeowners. The $100,000 home has hidden costs, not hidden in the sense of deliberately concealed. They're disclosed in all the appropriate legal documents. Hidden in the sense that they're not in the headline price, they don't show up in the mortgage payment estimate, and they consistently surprise new homeowners with their size and their unpredictability. The most significant hidden cost category is maintenance and repairs. The standard advice from financial planners is to budget 1% of a home's value per year for maintenance, which on a $100,000 home means $1,000 per year, or about $83 per month. But this is a long-run average that conceals enormous year-to-year variability. Some years, nothing major breaks and you spend $200 on a plumber. Other years, the roof needs work. $5,000 to $15,000, or the HVAC system fails, $3,000 to $8,000, or the water heater gives out, $800 to $2,000, or the electrical panel needs updating, $2,000 to $4,000. In the years when something major fails, the 1% budget is nowhere near adequate. This is particularly relevant for homes in the $100,000 price range because these homes are often older. The affordable housing stock in markets like Detroit, Cleveland, and Birmingham skews toward homes built in the 1940s through 1970s, homes with character and history and hardwood floors and potentially outdated plumbing, outdated electrical, original windows with poor insulation, aging roofs, and mechanical systems that are well past their designed lifespan. The cheap purchase price often reflects a deferred maintenance situation, previous owners who couldn't or didn't keep up with repairs, selling the accumulated problem to the next buyer at a discounted price. This is not an argument against buying these homes. Many of them are excellent values, even accounting for needed repairs. The purchase price is low enough that the math works out even after a significant renovation budget, but it is an argument for approaching the $100,000 purchase with clear eyes about what you're buying and with a realistic maintenance budget that goes beyond the mortgage payment. The second major hidden cost is utilities. Older homes, the homes that make up most of the $100,000 inventory, are typically less energy efficient than newer construction. Older windows, older insulation, older HVAC systems mean higher utility bills. In cities with harsh winters like Detroit and Cleveland, heating bills in poorly insulated older homes can be substantial, $200 to $400 per month during winter months. This cost rarely shows up in any affordability calculation, but it absolutely shows up in your monthly budget. The third hidden cost is HOA fees, which don't apply to most single-family homes in the $100,000 price range, but do apply to condominiums and some townhome communities. If the $100,000 property you're looking at is a condo, make sure you know the HOA fee, what it covers, what the reserve fund situation is, and whether any special assessments are being contemplated. A $100,000 condo with a $400 per month HOA fee has a dramatically different total monthly cost than a $100,000 single-family house, and the HOA fee on a condo is not something that builds equity. It goes away when you sell. The fourth and increasingly significant hidden cost is homeowners insurance, particularly in markets that are beginning to experience climate-related risk repricing. Most of the geography where $100,000 homes exist is not yet facing the insurance crisis that has afflicted Florida, coastal Louisiana, and parts of California. But some parts of the South are beginning to see insurance rate increases that reflect increasing severe weather frequency. Before purchasing any home, including a $100,000 home, get an actual insurance quote for that specific property in that specific location before you close. Do not assume the previous owner's rate is what you'll pay. Insurance markets are volatile, right now in ways that are not always predictable from the purchase price or the location's general reputation. Chapter 7. The income profiles. Exactly who can pull this off. Here's the section that most housing content refuses to write because it requires being specific, and specific means someone is going to be excluded and potentially unhappy about it. But this video is not about making everyone feel included in a fantasy. It's about answering the actual question. So let's walk through the specific income profiles of the people who can, in 2026, genuinely afford a $100,000 home, not technically qualify on paper, but actually, sustainably, without destroying their financial life, afford one. Profile 1. The local worker in an affordable market. This is the most straightforward profile and the one that represents the largest actual buyer pool for $100,000 homes. A person, or a household, who already lives in one of the markets where these homes are abundant, earns a local wage, and is looking to transition from renting to owning. In Decatur, Illinois, the median household income is roughly $47,000. In Cleveland, it's approximately $35,000 for the city itself, and higher in the metro. In Birmingham, it's around $42,000. These are not high incomes by national standards, but remember the mortgage math from Chapter 2. You need roughly $28,000 to $35,000 in income to qualify for a $100,000 mortgage. assuming manageable existing debt. At $47,000, a Decatur household earning the local median is comfortably above that threshold. For this buyer, the $100,000 home is genuinely accessible. The mortgage payment, around $840 per month including taxes and insurance, represents less than 25% of their gross monthly income of roughly $3,900. That's below the 28% front-end debt-to-income ratio that most lenders want to see, meaning they qualify comfortably. The challenge is the down payment. At $47,000 gross income, after taxes and living expenses, accumulating $10,000 to $20,000 in savings requires discipline and time, typically 2 to 4 years of focused saving. But it's achievable, and in markets where the median home price is near or below $100,000, the alternative, continuing to rent, often means paying $700 to $1,000 per month for comparable space, making the savings discipline clearly worth it. Profile 2, the remote worker arbitrage play. This is the profile that has generated the most cultural conversation in housing over the past few years, and for good reason. It's a genuinely interesting and financially powerful strategy that the rise of remote work has made newly possible for a significant number of Americans. 20% of remote workers plan to relocate in 2025, with cost of living cited as a significant motivator by 37% of those planning to move, and 29% of those planning to move were doing so specifically to buy a house. The motley fool. The math of the remote worker arbitrage is almost embarrassingly favorable when you work through it. Someone earning a coastal market salary, let's say $85,000 working remotely for a tech company based in San Francisco, who relocates to Decatur, Illinois, or Cleveland, Ohio, is earning roughly double the local median income in a market where the median home price is $90,000 to $140,000. They are, by local standards, wealthy. Their income to housing cost ratio is extraordinary. At $85,000 in annual income, this buyer is looking at a monthly gross of about $7,083. The all-in monthly payment on a $100,000 home, approximately $840, represents just under 12% of their gross income. That's less than a third of what the commonly cited 30% affordability threshold would permit. They have enormous financial breathing room. They can make a substantial down payment that eliminates PMI. They can have a well-funded emergency reserve. They can renovate the kitchen and still be financially comfortable. Their coastal salary in an affordable Midwestern or Southern market is essentially a financial superpower. Many professionals are moving away from expensive urban centers to suburban and even rural areas with lower costs and more space. Housing markets in smaller towns and rural areas have seen a significant uptick in demand as remote workers can live anywhere without the necessity of a daily commute. Ramsey Solutions. This migration trend has real consequences for affordable housing markets. As more remote workers discover them, demand increases and prices rise. Several markets that were deeply affordable 5 years ago have seen meaningful price appreciation precisely because remote workers moved in and competed with locals for limited housing supply. This is the double-edged nature of the remote work housing arbitrage. The people who find it first get the best deals. The people who follow later find prices that have risen to reflect the demand they brought. The practical requirements for the remote worker profile to work: a genuinely remote job that won't suddenly require in-office presence, reliable high-speed internet at the destination, which is a real limitation in some rural areas and a genuine consideration in the Appalachian markets, and a personal comfort with a lifestyle that is different from what coastal metros offer. This last point is not trivial. Many people discover, after making the move, that they miss the urban amenities, the cultural density, the professional networking ecosystem, and the social environment of a major city more than they anticipated. The financial math of remote work arbitrage is undeniable. The lifestyle fit is deeply personal and must be evaluated honestly. Profile 3, the retired or near-retired fixed-income buyer. Here's a buyer profile that doesn't get nearly enough attention in housing content: the retiree or near-retiree who is looking to significantly reduce their housing cost as part of a broader retirement financial strategy. For a retiree, Receiving Social Security income, the median Social Security retirement benefit is approximately $1,900 per month or $22,800 per year, combined with a pension, 401k distributions, or other retirement income that brings total income to $35,000 to $50,000 annually. A $100,000 home is genuinely well within reach. And the financial logic of a retired buyer in an affordable market is particularly compelling. Lower property taxes, lower insurance, lower utility costs, and a mortgage payment that is a fraction of what rent would cost, all combine to dramatically reduce the monthly cash outflow from a fixed income. Many retirees choose to purchase in affordable markets with cash, using proceeds from the sale of a higher-priced home in a market they've left, which eliminates the mortgage entirely and makes the ongoing monthly cost of housing just property taxes, insurance, utilities, and maintenance. On a $100,000 house owned outright with no mortgage, generating 8% cap rate, returns on rental income would mean $8,000 per year in positive cash flow. Bank of America, institute for a retiree who doesn't need the rental income and simply wants to minimize housing costs. The all-cash purchase of a $100,000 home can reduce monthly housing expenses to $300 to $500 per month. Property taxes plus insurance, plus a maintenance reserve, which is extraordinary by any national benchmark. The retired buyer's main consideration in this profile isn't income qualification, it's healthcare access at the destination. Retirees who move to deeply rural affordable markets sometimes discover that healthcare infrastructure is limited, that specialist care requires long drives, and that the nearest hospital with certain capabilities is an hour away. For buyers who are younger and healthy, this is a minor consideration. For older buyers managing chronic conditions, it's a genuine constraint that must factor into the location decision. Profile 4, the first-time buyer with program assistance. This is the buyer who sits at the intersection of genuine need, available resources, and a system of assistance programs that, while imperfect and paperwork intensive, can meaningfully bridge the gap between technically qualifies and actually able to close. As of Q4 2025, there are 2,619 down payment assistance programs available nationwide, a 6% annual increase from Q4 2024. The average benefit across all programs is about $18,000, and many programs also cover closing costs, prepaid expenses, and mortgage rate buy-downs. 62% of nationwide offerings have income limits above $100,000, meaning far more people qualify than realize it. Kiplinger, $18,000 in average assistance. On a $100,000 home, that's essentially the entire 20% down payment covered by assistance programs, allowing the buyer to close with minimal personal savings, eliminate PMI, and start homeownership with meaningful equity. Many state-level DPA programs now provide grants of up to $15,000 to $20,000, easing the burden on first-time buyers. There are also revived first-time homebuyer tax credits allowing eligible buyers to claim up to $15,000 in tax credits, reducing the overall cost of home ownership. Guardian Life. The profile of a buyer who can maximally benefit from these programs, income below the area median income or in the 80 to 120% AMI range, which in affordable markets is often $35,000 to $65,000, a credit score of 620 or above, 640 or better for most conventional programs, no prior home ownership in the past 3 years, and willingness to complete a homebuyer education course, which is typically required and takes about 8 hours. This is not an exotic buyer. This is a nurse, a teacher, a warehouse worker, a small business employee, people doing necessary work in their communities at wages that are reasonable for local cost of living, but that have historically made home ownership feel out of reach. Profile 5. The cash investor. The final profile is the one that most annoys first-time buyers looking at affordable markets, and that has the most complex moral and economic implications. The cash investor buying $100,000 homes as rental properties or as flips, with no mortgage qualification required and no personal occupancy intended. For a cash buyer, whether an individual investor, a small real estate investment company, or a larger institutional buyer, A $100,000 property in a stable rental market with good cash flow fundamentals is a genuinely attractive asset. In 2025, many landlords target a cash-on-cash return between 8 to 12% on rental properties, and some Sunbelt and Midwest markets still offer affordable prices relative to rent, creating better opportunities for investors. Experian. In the best U.S. markets, rental properties produce cap rates of 6 to 10%. On a $100,000 house owned outright with no mortgage, an 8% cap rate means $8,000 per year in positive cash flow. Bank of America. Institute $8,000 per year in cash flow on a $100,000 investment is an 8% annual cash return, before appreciation, before principal paydown, and before the tax advantages of depreciation that shelter a significant portion of that income. In an investment landscape where a 10-year Treasury bond yields roughly 4.5%, the risk-adjusted return on a well-selected affordable rental property is genuinely competitive, and investors know it. The investor profile can afford a $100,000 home in the most literal sense. They have the cash, they have no mortgage qualification hurdle, and the transaction closes quickly and cleanly. Their presence in affordable markets is real, documented, and consequential for the buyers who need to finance their purchase and compete in a market where cash offers consistently win. The tension between investor buyers and owner-occupant buyers in affordable housing markets is one of the defining policy debates in housing right now, and we'll return to it later. Chapter 8: The Remote Work Revolution: How Location Independence Changed Everything. Let's spend a full chapter on the remote work dimension of the $100,000 housing conversation, because it is genuinely the most transformative force reshaping where Americans can live and what they can afford, and its full implications are still playing out in ways that affect both the opportunity side and the risk side of the affordable housing equation. Research from the National Bureau of Economic Research estimates that the shift to remote work explains over one-half of the 18.9% increase in U.S. real house prices from 2019 to 2023. Bankrate more than half of the pandemic housing boom was driven not by low interest rates alone, not by investor speculation alone, but by the fundamental behavioral shift of millions of Americans suddenly discovering that they could live anywhere. And when you can live anywhere, you move toward value, toward more space, more nature, lower costs, better quality of life per dollar of housing expenditure. It is projected that by 2025, around 22% of the American workforce will spend a significant portion of their time working remotely. Ramsey Solutions: 22% of the entire American workforce. Location independent, or at least location flexible, in a way that no previous generation of workers has ever been. This is not a temporary blip. Remote work has restructured the entire geography of American economic life in ways that are likely permanent, even as some employers push for return to office. The migration data confirms the behavioral shift. South Carolina welcomed more new residents per capita than any other state in 2025, with a net gain of 79.7 residents per 10,000 people. Idaho followed closely behind, adding 63.2 residents per 10,000. Continuing a trend fueled by relative affordability and lifestyle appeal. Idaho remains significantly more accessible in terms of housing costs compared to neighboring western states. Yahoo Finance people are voting with their addresses, and they're voting for affordability, for space, for a different quality of life than the expensive coastal metros offer. The question is whether the affordable markets they're moving to will remain affordable after the influx, which is where the story gets complicated. Remote workers tend to be employed in relatively high-income industries like tech and finance, enabling high-income workers to cast a wider net in search of bigger homes and more amenities. Workers untethered from in-office requirements ventured further out into the suburbs, causing prices to rise in these areas. Smart asset. This is the uncomfortable flip side of the remote work housing story. The remote worker who moves from San Francisco to a small Midwestern city brings their coastal salary and their coastal spending power. To them, a $150,000 house is a bargain. To the nurse or the teacher who grew up in that city and earns a local wage, a $150,000 house that was $100,000 2 years ago is a housing crisis in slow motion. The remote work migration improves the financial lives of the people who can do it and gradually makes life harder for the local residents who cannot. For the remote worker considering the $100,000 housing strategy, several practical considerations deserve serious attention before moving. Internet infrastructure is the non-negotiable baseline. A remote worker without reliable high-speed internet has no job. In most established small cities, Decatur, Cleveland, Birmingham, Rochester, internet infrastructure is adequate. In deeply rural areas, particularly in Appalachia and parts of the South, fiber internet may not be available at all, and the best available option may be satellite internet, which has improved dramatically with services like Starlink, but is still more expensive and less reliable than fiber. Before purchasing any home in a rural affordable market, verify the actual internet options at the specific address, not what's theoretically available in the county, what's actually available at the property. 32% of remote workers report their real estate needs have changed since transitioning to remote work, with the need for home offices topping the list of changed housing requirements at 24%, followed by the need for quiet space at 19% and more space overall at 19%. The Motley Fool. A $100,000 home in an affordable market frequently offers more square footage than what a remote worker was renting in a major city, which is a feature, not a bug. The 3-bedroom house in Cleveland with a dedicated home office and a backyard is a materially better work-from-home environment than the 1-bedroom apartment in Chicago, where the home office was a corner of the bedroom with a tension rod between you and the bed. The community consideration is real and should be addressed honestly. 43% of remote workers cite change of scene as their primary reason for relocating, while 24% are doing so to be closer to family and friends. The Motley Fool. The people who relocate to be closer to existing community, family, old friends, known social networks, tend to have significantly better experiences in affordable markets than the people who move cold to a place where they know nobody, attracted by the financial math. The financial math is real. The social isolation risk in a town where you have no existing connections is also real. Remote workers who build their social lives primarily through digital connections and periodic travel to see geographically dispersed friends may find small city life perfectly sufficient. Those who thrive on the density and spontaneity of urban social environments often find they miss it more than they anticipated. Chapter 9. The Investor Angle. Competition you didn't know you had. Here's the part of the $100,000 housing conversation that is absolutely necessary to understand and that the cheerful, affordable housing exists narrative often omits. You are not the only person who has noticed that these homes are cheap. Investors often target single-family homes in neighborhoods near major medical centers and universities. Properties in safe working-class areas in Midwest cities like Cleveland typically achieve positive cash flow from day one with 25% down conventional financing. Midwest markets offer 8 to 12% cash-on-cash returns with entry points of $150,000 to $300,000, making them among the most attractive for investors prioritizing immediate income and portfolio building. Experian. The investment math on affordable housing markets is compelling. A $100,000 home that rents for $950 to $1,100 per month, which is realistic in many of the markets we've discussed, is generating gross rent of roughly 11 to 13% of purchase price annually, after expenses, mortgage, taxes, insurance, management, maintenance. A well-selected property can still generate 7 to 9% cash-on-cash return. For a leveraged investor, that's competitive with stock market returns, with the added benefits of leverage, appreciation, depreciation deductions, and real property ownership. The problem, from the perspective of a first-time owner-occupant buyer, is that investors know this math, they know it very well, and they shop in the same markets for the same properties. The difference is that investor buyers, particularly cash investors, have structural advantages in competitive situations that owner-occupant buyers simply cannot match. A cash offer closes faster with fewer contingencies and with zero risk of financing falling through. In a competitive market, sellers consistently prefer cash offers, and many will accept a slightly lower cash offer over a financed offer at a higher price because of the certainty and speed. Good deals in affordable markets will fly off the shelf. You need to know your numbers and make offers fast. NerdWallet. This is advice written for investors. And it perfectly describes the competitive environment that owner-occupant buyers in affordable markets are operating in. Homes that are priced well, in decent condition, in good neighborhoods, do not sit on the market in Cleveland or Birmingham. They get multiple offers, often within the first week. The people who win those offers tend to be cash buyers or very well-prepared financed buyers who can move quickly. For the owner-occupant buyer competing against investors, several strategies improve the odds. Being pre-approved, not just pre-qualified, actually pre-approved with a credit check completed and a commitment letter from the lender, signals to sellers that your financing is solid and will close. Offering to close quickly, with a short inspection period, reduces the uncertainty that makes sellers prefer cash, and in some cases, writing a personal letter to the seller explaining that you intend to live in the home rather than rent it out appeals to sellers who prefer their home to go to an owner-occupant, though fair housing concerns have led some real estate agents to advise against this practice in competitive markets. The institutional investor dimension of affordable housing is a larger and more politically contentious conversation. Large institutional buyers, the Invitation Homes and First Key Homes of the world, owning tens of thousands of single-family rentals, have been active in affordable Midwest and Sunbelt markets for years. Their presence is documented, their scale is significant, and the policy debate about whether to restrict institutional single-family home ownership is genuinely live and contested. Invitation Homes currently owns over 86,000 homes and has joint venture interests in nearly 8,000 additional homes, managing more than 16,000 properties for third-party investors, focusing on markets that benefit from above-average population and employment growth rates. The motley fool. The practical implication for the individual buyer trying to purchase a $100,000 home. In the most desirable and best-positioned affordable markets, you are competing with a sophisticated, well-capitalized buyer pool that includes professional real estate investors at both the individual and institutional level. This doesn't make the purchase impossible, but it makes preparation, speed, and clear financial positioning more important than the real estate industry's "take your time, find the perfect home" narrative would suggest. Chapter 10. First-time buyer programs. The $18,000 you might not know about. We touched on down payment assistance programs in the context of buyer profiles. Let's go deeper, because the scale and scope of what's available in 2026 is genuinely remarkable and genuinely underutilized. Down payment assistance programs totaled 2,619 nationwide as of Q4 2025, a 6% annual increase from the previous year. The average benefit is about $18,000, and 1,639 programs, 63%, are open to first-time buyers, an 8% increase from a year ago. More than 1,000 programs offer partial or full forgiveness over time. Kiplinger, 2,619 programs, offering an average of $18,000, 63% of which are specifically for first-time buyers. On a $100,000 home, $18,000 is 90% of a 20% down payment. The down payment that most people identify as their primary barrier to homeownership can be substantially or entirely covered by programs that the majority of eligible buyers have never investigated. Why don't more people know about and use these programs? Several reasons, all of them frustrating. First, awareness. These programs are administered by a patchwork of state housing agencies, local governments, nonprofits, and lenders, none of whom have the marketing budget or reach to ensure that every eligible buyer knows they exist. Second, complexity. The eligibility requirements, application processes, and terms vary significantly from program to program, and navigating them requires research and assistance from a mortgage professional who is familiar with the specific programs available in the buyer's target market. Third, stigma. Some buyers feel that using assistance programs represents a kind of financial inadequacy, which is a cultural attitude that has no relationship to financial reality and that costs real money to the people who avoid help they qualify for. 62% of nationwide DPA offerings have income limits above $100,000, meaning far more people qualify than realize it. Kiplinger. This is perhaps the most important and most surprising data point in the entire assistance program landscape. More than half of available programs have income eligibility limits above $100,000 per year. A significant portion of people who assume they make too much to qualify for any assistance program are wrong. The programs are not only for the lowest income buyers, they serve a broad swath of the moderate income market. The teachers, nurses, firefighters, government workers, and office professionals who earn enough to afford a mortgage but struggle to accumulate the lump sum down payment. The specific landscape of programs available to a buyer targeting a $100,000 home in an affordable market typically includes a state housing finance agency program offering a low-interest second mortgage or grant for down payment assistance, potentially a local government program targeting specific neighborhoods or income levels, lender-specific programs from banks participating in Community Reinvestment Act goals, and federal programs including FHA, USDA, and VA loans that reduce or eliminate the down payment requirement directly. The most effective approach is to find a mortgage lender or HUD-approved housing counselor in the target market who specializes in affordable homebuyer programs. These professionals know the local program landscape, understand the application, timing, and requirements, and can help a buyer layer multiple programs using one program's assistance for the down payment and another's for closing costs in ways that dramatically reduce or eliminate the upfront cash required to close. The homebuyer education requirement that most programs impose, typically an 8-hour course covering budgeting, the home purchase process, mortgage basics, and the responsibilities of home ownership, is genuinely valuable rather than just a bureaucratic hurdle. Buyers who complete these courses consistently make better decisions in the purchase process and experience lower rates of early default. It is, in the most literal sense, 8 hours of education that can save thousands of dollars and prevent serious financial harm, and it is the price of admission to assistance programs that can provide tens of thousands of dollars in help. Chapter 11. The Fixer-Upper Reality. What needs TLC actually means in 2026. Let's talk about condition, because a significant portion of the homes available under $100,000 in 2026 are in that price range for a reason, and that reason is often spelled out euphemistically in the listing description as needs TLC, great bones, investor special, as is sale, or the most honest and therefore most terrifying listing phrase in all of real estate, bring your contractor. The affordable housing stock in markets like Detroit, Cleveland, and Birmingham is predominantly older, homes built in the 1940s, 1950s, and 1960s that have been owned by multiple generations, have varying maintenance histories, and may carry deferred maintenance that ranges from cosmetic to structural. Understanding what you're actually buying in this price range requires a level of due diligence that goes beyond a standard home inspection, though a standard home inspection is the absolute minimum starting point. Here's what needs TLC can mean on a $90,000 home in Cleveland's East Side. Fresh. Paint and updated light fixtures. Total cost, maybe $3,000. Or it can mean roof at end of life, $8,000 to $15,000. Knob and tube wiring that needs to be replaced, $5,000 to $12,000. Lead paint remediation, $3,000 to $10,000. Plumbing that dates to the original construction and uses galvanized steel pipe that's corroding from the inside, $4,000 to $8,000, and a furnace that's 25 years old and could fail this winter, $3,000 to $5,000. In the worst case scenario, that $90,000 house has $40,000 in mandatory remediation before it's safely habitable. The actual cost of that home is $130,000. And at $130,000 in a $90,000 market, you've bought the most expensive house on the block. This is not an argument against buying fixer-uppers. Many buyers who understand what they're getting into do extremely well with them, building equity through sweat and smart renovation decisions in markets where move-in ready homes command significant premiums. It is an argument for knowing what you're getting into before you get into it. The FHA 203K loan is specifically designed for buyers who want to purchase a home that needs rehabilitation. It combines the purchase price and estimated renovation costs into a single mortgage, allowing a buyer to acquire a distressed property and fund the repairs simultaneously, without needing separate financing. On a $100,000 total budget, you might purchase a $70,000 property and borrow $30,000 for renovation, all in one loan, one closing, one set of mortgage payments. The catch, the FHA 203K has specific requirements about the scope of work, requires licensed contractors, no DIY credit, and involves an FHA-approved consultant who oversees the renovation process. It's more complex than a standard purchase, but it unlocks properties that would otherwise be inaccessible to buyers who can't separately finance renovations. The buyers who do best in the fixer-upper market in affordable cities are typically those with construction knowledge themselves, contractors, tradespeople, engineers, or at least people who have done significant home improvement work before and have a realistic understanding of what things cost and how long they take. They can accurately assess a distressed property's condition, estimate renovation costs with reasonable accuracy, and either do some of the work themselves or manage contractors without being taken advantage of by bids that are inflated for buyers who clearly don't know what they're doing. The buyers who struggle most in the fixer-upper market are those who fall in love with the architectural character of an old house, the hardwood floors, the original woodwork, the high ceilings, and underestimate the systems underneath. The character is real: the leaky basement, the failing electrical, the HVAC system held together by duct tape and optimism, those are also real. A thorough inspection by an experienced inspector who knows how to evaluate older housing stock, combined with specialist evaluations of structural, electrical, and plumbing systems before contract, is not optional in this price range. It is the single most important due diligence step available, and skipping it in the interest of saving the $400 to $600 inspection fee is false economy of the most expensive kind. Chapter 12. The local job market question. Can you actually live there? We've talked extensively about who can afford a $100,000 home financially. Now let's talk about the life question that sits underneath the financial one. Can you actually build a life in the places where these homes exist? Specifically, is there work? Is there career opportunity? Is there an economic foundation that makes the community viable, not just today, but in the years and decades of a mortgage term? This is where the conversation gets genuinely nuanced, because the geographic distribution of affordable housing maps, with meaningful overlap, onto the geographic distribution of economic challenge. The communities where housing is cheapest are often the communities that have experienced manufacturing decline, population loss, and the economic contraction that accompanies both. Detroit's housing is cheap in part because Detroit lost roughly half its population between 1950 and 2020. Decatur's housing is affordable in part because major employers left and the economic base contracted. The housing market is a pricing mechanism, and when it prices something very cheaply, it's usually because demand is lower than supply, which often means people are leaving rather than arriving. This is not universally true. Some affordable markets are cheap because they've historically been overlooked rather than because they're economically declining. Rochester, New York, has a diverse economic base anchored by healthcare, education, and technology. Birmingham has a growing medical and financial sector. Cleveland has major healthcare institutions and the Cleveland Clinic and university hospitals that provide stable, high-quality employment. These aren't ghost towns. They're cities with real economic foundations that happen to have housing markets that never got expensive. But for buyers who are considering relocating to an affordable market, rather than buyers who already live there, the job market question is critical. South Carolina welcomed more new residents per capita than any other state in 2025, with job-driven growth translating into consistent monthly population gains as employers continue to expand operations, particularly along major interstate corridors and coastal metros. Yahoo Finance. South Carolina's growth is driven by real employer expansion, which means it's a market where you can arrive, find work, and find community. The markets growing from employer expansion are very different from markets growing primarily from retirees and remote workers, and both are different from markets that are losing population and struggling economically. For the remote worker, the local job market question is secondary to the internet infrastructure question. If your income is location independent, the local employment environment matters for community vitality and long-term property value rather than for immediate income. For the buyer who needs to find local employment, it's primary and must be evaluated honestly before committing to a market. Buying a $100,000 house in a community with limited job opportunities, counting on finding adequate local employment after purchase, is a high-risk strategy that has ended badly for a meaningful number of buyers who prioritize the housing affordability without adequately evaluating the employment landscape. The most sustainable affordable housing markets in 2026 are the ones that combine genuinely low housing costs with real economic foundations: healthcare, education, government employment, manufacturing that has survived modernization, or proximity to larger metro areas that provide employment access without metro-level housing costs. These markets exist. Finding them requires looking beyond the headline median home price to the underlying economic conditions that will determine whether that price reflects an opportunity or a warning. Chapter 13: The Racial Home Ownership Gap. Why the $100,000 home story is not equal for everyone. Here's the chapter that most real estate content skips entirely because it's complicated and uncomfortable and requires sitting with data that doesn't resolve neatly. But this video is about who can actually afford a $100,000 house in 2026, and that question cannot be answered honestly without confronting the fact that the answer is distributed unequally across racial and ethnic lines in ways that are documented, persistent, and not primarily a matter of individual financial behavior. The U.S. home ownership rate for Black households was around 45% in 2023 compared to 72% for white households, 63% for Asian households, and 51% for Hispanic households. Smart asset. The 27 percentage point gap between Black and white home ownership rates is not a recent development. Even with recent improvements, the home ownership gap between Black and white Americans is actually wider today than it was in the 1960s, when it was legal to refuse to sell a home to someone because of their race. Empower. Let that sit there for a moment. The racial home ownership gap is larger today than it was at the moment when housing discrimination was legally sanctioned. The decades of policy interventions, fair housing legislation, and community development initiatives have not closed a gap that overt legal discrimination created. By some measures, they've presided over its widening. The home ownership gap is intrinsically linked to the growing wealth gap between Black and white Americans. White households have a median net worth at least 10 times that of Black households. Freedom for all Americans. This is the compounding cycle at the heart of the racial wealth gap. Home ownership builds wealth through equity appreciation, and wealth enables home ownership through down payments, credit history, and financial resilience. The households excluded from home ownership accumulate less wealth. Less wealth makes home ownership harder to access. The cycle perpetuates itself across generations in ways that compound dramatically over time. In the context of $100,000 homes specifically, the racial dynamics deserve careful examination because affordable housing markets are not racially neutral spaces. Many of the cities where $100,000 homes are most available, Detroit, Birmingham, Cleveland, Baltimore, have majority Black or significantly Black populations. The affordability of housing in these markets is, in significant part, a legacy of the very disinvestment, redlining, and discriminatory policies that suppressed Black homeownership for generations. The cheap housing exists partly because systemic discrimination kept these neighborhoods undervalued. The irony that affordable housing opportunities for Black buyers often sit in neighborhoods whose affordable prices reflect historical discrimination against Black residents is not lost on anyone who looks closely at this dynamic. Black buyers were most likely to report discrimination during their transaction in the type of loan product they were offered. 47% reported this experience. 5% of Black and Asian buyers experienced discrimination based on race during their home purchase. Credible, not historical discrimination. Current, documented, happening now discrimination in the loan products offered to Black buyers at higher rates than their white counterparts. The denials aren't generally fueled by overt discrimination, but rather by ingrained practices in the mortgage industry that make it hard for Black Americans, with less intergenerational wealth, poorer credit scores on average, and a lower debt-to-income ratio. To qualify, as one researcher put it, the way we measure risk does nothing but pass on historical discrimination and racism. Freedom for all Americans. The credit scoring system is a particular mechanism of this perpetuation. Credit scores reflect credit history. Credit history reflects access to credit over time. Access to credit has historically been distributed unequally along racial lines, through redlining, through differential lending practices, through the wealth gap that makes it harder to weather financial disruptions without credit damage. A system that measures creditworthiness based on historical credit behavior will, in a society where historical credit access was distributed unequally by race, produce racially differentiated credit scores that are not primarily a reflection of individual financial behavior. They are, in significant part, a measurement of historical discrimination and its compounding effects. The typical down payment was highest among Asian buyers at 21% and white buyers at 19%. 42% of black buyers reported having student loan debt, significantly higher than other groups. Credible. The student loan dimension is particularly acute in the black homeownership story. Higher rates of student loan debt among black buyers, reflecting both higher rates of college attendance for economic mobility and the fact that black families have less intergenerational wealth to contribute to education costs, directly reduce the debt-to-income ratios that lenders use to qualify borrowers and determine rates. A black buyer with the same income as a white buyer, but with $50,000 in student loan debt has a worse DTI ratio, qualifies for a smaller loan, and pays a higher rate. The student debt crisis and the racial homeownership gap are, in the mortgage market, the same crisis wearing two different name tags. There are genuine reasons for cautious optimism in this data. Hispanic Americans registered the largest homeownership rate increase of any racial group over the past decade, up 5.8 percentage points, representing 3.5 million new homeowners. Ramsey Solutions: 1 in 3 Hispanic households falls into the 25 to 40 age group of prime home-buying age. Ramsey Solutions suggesting that demographic momentum will continue to drive Hispanic homeownership growth. And the $100,000 price range, with its lower down payment requirements and lower income thresholds, is more accessible to first-generation homebuyers of all racial backgrounds than the national median market would be. Of first-time homebuyers, 49% are black, 43% are Asian, and 41% are Hispanic, compared to 20% of white buyers. Credible non-white buyers are dramatically more likely to be first-time buyers, which means they're more likely to be entering the market without the equity cushion of a prior home sale, without the intergenerational wealth transfer of family gifts toward down payments, and without the experiential knowledge of prior home purchases. They're navigating the most complex financial transaction most people ever undertake, disproportionately without the safety nets that many white buyers have access to. Down payment assistance programs are critically important in this context. Black buyers use community and government down payment assistance programs at higher rates than other groups. Credible, which suggests both that these buyers need the assistance and that they're finding it when they know it exists. The scale-up of DPA programs targeting first-generation and first-time buyers of color is, in this data, one of the most impactful policy levers available for closing the homeownership gap in markets where $100,000 homes create an otherwise accessible entry point. The bottom line on the racial dimension of $100,000 home affordability: the financial barriers are real and are not randomly distributed. A black buyer pursuing a $100,000 home in 2026 is statistically navigating higher student loan debt, lower inherited wealth for down payment assistance, credit scoring systems that reflect historical discrimination, higher rates of experiencing discrimination in the loan product offered, and less access to the intergenerational wealth that makes the transaction smoother for many white buyers. None of this makes the purchase impossible. Many black buyers successfully purchase homes at every price point every year, and the $100,000 market is more accessible than the national median market precisely because the financial thresholds are lower. But accessibility and equality of access are not the same thing, and honest treatment of who can afford a $100,000 house requires acknowledging that the barriers are meaningfully higher for some buyers than others. Chapter 14: The 7 Mistakes that Blow Up the $100,000 Home Purchase. Let's get operational, because this video is not just about understanding the landscape. It's about helping the people who are genuinely trying to make this work avoid the specific, documented, entirely preventable mistakes that consistently derail affordable home purchases. Here are the 7 most consequential ones. Mistake 1: confusing pre-qualification with pre-approval. One of the biggest mistakes first-time buyers are making in 2026 is confusing a pre-qualification with a true pre-approval. A pre-qualification is often based on self-reported information. A full pre-approval involves a credit check, income verification, and underwriting review. Fidelity. In competitive, affordable markets, where well-priced properties attract multiple offers within days of listing, showing up with a pre-qualification letter is showing up underprepared. Sellers and their agents know the difference. A pre-approval signals that your financing is real, verified, and likely to close. A pre-qualification signals that someone did some math with the numbers you told them. Get pre-approved fully before you start looking. Seriously. Mistake 2. Focusing only on the mortgage payment. One of the biggest mistakes first-time buyers make is focusing only on what they can afford monthly instead of what they should afford long-term. In 2026, affordability is shaped by more than just interest rates. Carry the mortgage payment is the most visible cost of homeownership. But as we established in Chapter 6, it's not the total cost. Many buyers focus only on the mortgage payment, but don't forget everything else that impacts affordability, such as homeowners insurance, property taxes, and home maintenance. These hidden costs can often derail a deal. Creative planning. Before making an offer, calculate the true all-in monthly cost, mortgage principal and interest, property taxes, homeowners insurance, any HOA fees, and a maintenance reserve. That's your real number. That's what needs to fit in your budget. Mistake 3. Skipping the home inspection. Skipping a home inspection to save money can be a costly mistake. A professional inspection can uncover hidden issues with the home, structural damage, pest infestations, or faulty wiring that may require expensive repairs. While an inspection fee may seem like an unnecessary expense, it can ultimately save thousands of dollars. Fox Business. In the $100,000 price range, where homes are frequently older and may have deferred maintenance, skipping the inspection isn't just a bad idea, it's potentially catastrophic. The $400 inspection fee is the cheapest insurance policy available in the home purchase process. And in 2026's market, while some buyers waive inspection contingencies in competitive situations to strengthen their offers, this strategy carries real risk, especially on older housing stock. Waiving inspection or appraisal contingencies prematurely is risky, especially now with cooling markets. Empower. In most affordable markets at the $100,000 price point, waiving inspections is not necessary to be competitive, and the downside risk is too high to justify it. Mistake 4. Underestimating existing debt's impact. Today's first-time homebuyers face unprecedented debt levels that directly impact purchasing power. In 2025, Americans carry average student loan balances of $38,375, auto loan payments of $745 per month for new cars, and credit card balances of $6,618. These obligations significantly affect the debt-to-income ratio, a key financial metric that measures the ability to manage monthly payments and take on new debt. The Motley Fool. On a $100,000 home, the mortgage payment is manageable on a modest income, but only if the rest of your debt picture is also manageable. A buyer earning $35,000 with $600 per month in student loan payments and $500 per month in a car payment has $1,100 per month in fixed debt obligations before the mortgage. Their remaining monthly capacity for a mortgage payment is limited, and their DTI ratio may put them right at or over the qualifying threshold even for an $80,000 loan. Paying down high-interest consumer debt before applying for a mortgage isn't just generally good financial advice, it's specifically effective at improving DTI ratios and credit scores simultaneously, addressing two of the biggest qualification barriers in one move. Mistake 5. Waiting for the perfect time. The idea of holding off on a home purchase in hopes of lower mortgage rates is tempting, but any rate drop that occurs in 2026 may be modest. If rates hold steady or even slightly increase, waiting could mean higher borrowing costs. If you are holding off for a certain rate while home values go up, it may get you a higher payment even with a lower rate. That $100,000 home today may be $110,000 or $115,000 by the end of 2026. Kiplinger. In affordable markets specifically, the inventory of genuinely good properties at genuinely low prices is limited and not growing dramatically. The house that fits your needs in your price range in your target market exists. right now, waiting for a theoretical future moment of perfect conditions, lower rates, lower prices, more savings, while that specific house sells to a more decisive buyer is a common and expensive form of analysis paralysis. Preparation creates options. Options create better outcomes. The time to buy the right house at the right price is when those two things are simultaneously true, not when some future economic forecast looks slightly more favorable. Mistake 6. Choosing the wrong market for the wrong reasons. This is the mistake with the longest and most painful consequences. Buying a $100,000 house in a market that doesn't suit your employment needs, your lifestyle requirements, or your long-term life plans because the house is cheap and the math is attractive is a decision that feels financially smart and lives as personally wrong for years. Purchasing a home that fits your current needs without considering future growth or resale value can lead to challenges. A home should be able to adapt to life changes. You can renovate, expand, and update a home. You can't change its location. CBS News. Before committing to any affordable market, spend time there. Not a weekend visit, meaningful time, enough to understand the community, the commute, the social environment, the cultural life, the winters if you're heading to the Midwest. Rent in the area for 3 to 6 months if the financial situation allows. The market research on where to buy is as important as the home research on what to buy, and it's the step that most buyers in a hurry skip. Mistake 7. Ignoring the resale picture. A $100,000 home in a stable or growing market is a financial asset that can appreciate, build equity, and eventually be sold to fund your next housing move. A $100,000 home in a declining market may be worth $80,000 or $70,000 in 5 years, meaning you've paid a mortgage for 5 years and lost equity rather than gained it. Many forecasts project modest price increases of 1% to 3% in 2026, though decreases are possible in some markets. Kiplinger. The resale picture varies enormously across affordable markets, and it's the variable that most first-time buyers don't adequately research. Look at 5 and 10-year price trends in the specific market. Look at population trends. Is the city growing or shrinking? Look at employer anchors. Are the major employers stable, growing, or at risk? A $100,000 home in a stable or growing Cleveland suburb has a different investment thesis than a $60,000 home in a shrinking rural county. Both might be affordable. One is a wealth-building vehicle. The other may be a wealth sink. Chapter 15. What actually makes it work. The common threads in success stories. Let's spend this chapter on the positive side of the ledger. The specific characteristics and decisions that show up consistently in the profiles of people who successfully purchased and thrived in affordable housing markets. Because while this video has necessarily covered a lot of complexity and nuance, the story of the $100,000 house does have genuinely happy chapters. People are doing this, they are making it work, and the ways they're making it work follow recognizable patterns. They research the market like a job. Every successful affordable home buyer who has told their story in Reddit threads, in local news profiles, in real estate community forums shares a common characteristic. They treated market research as a serious undertaking rather than a casual browse on Zillow. They studied price trends over 5 and 10 years. They read local news about major employers, infrastructure investments, and population trends. They joined local Facebook groups and community forums to understand neighborhood dynamics from people who actually live there. They visited multiple times at different times of year. They spoke with local real estate agents, not just national online platforms, who had granular knowledge of specific streets, specific neighborhoods, specific quirks of the local market that no algorithm captures. The people who bought well in Cleveland, in Birmingham, in the Quad Cities, in Rochester, they knew those markets. Not perfectly, but meaningfully. They had formed specific views about which neighborhoods were stable versus improving versus declining. They had a list of streets they'd buy on and streets they wouldn't. They understood why certain blocks were cheap and whether the cheapness reflected opportunity or warning. That knowledge didn't happen by accident. It was built deliberately over months of focused attention to a specific geography. They fixed their financial profile. Before applying, the successful $100,000 buyers rarely arrived at their purchase with their financial profile exactly as they'd always had it. Most of them spent 12 to 24 months, sometimes longer, deliberately improving the specific financial metrics that mortgage qualification depends on, paying down credit card balances to improve credit utilization, making every payment on time for 18 straight months to build payment history, aggressively saving for a down payment while resisting lifestyle spending temptations, negotiating down or paying off student loans where possible to improve DTI ratios, checking their credit reports and disputing errors, which are surprisingly common and can significantly and unnecessarily depress credit scores. This preparatory period is not glamorous. It's not the part of the homeownership story that makes compelling social media content, but it is, consistently, what separates the buyers who successfully close from the buyers who try, get declined, or quoted unworkable rates, and either give up or continue renting while their finances remain unchanged. The boring, patient, pre-purchase financial work is the foundation that makes everything else possible. They used every available program. The buyers who got the best outcomes in affordable markets were, almost universally, buyers who left no assistance money on the table. They worked with HUD-approved housing counselors who knew the specific program landscape in their target markets. They stacked down payment assistance programs. They applied for first-time homebuyer tax credits where available. They pursued FHA loans where their credit profile and down payment made it the right tool. They asked every lender they spoke with what programs they offered or could connect them to, rather than assuming that what was advertised was all that was available. The assistance landscape is not intuitive, is not well marketed, and rewards the buyers who treat finding it as a research project rather than a bureaucratic box-checking exercise. The $18,000 average assistance benefit we discussed earlier is real money. It doesn't appear automatically. It requires application, qualification, documentation, and timing coordination that can be complex. The buyers who navigate that complexity successfully are the buyers who understood from the beginning that the assistance was there if they looked for it. They budgeted, honestly, for total ownership. Cost. Every successful affordable buyer who is actually thriving, not just surviving, in their $100,000 home went in with a budget that honestly accounted for the total cost of ownership: the mortgage, the taxes, the insurance, the utilities, the maintenance reserve, and a realistic assessment of the initial repair or update costs required by the specific property they purchased. They didn't fall in love with a house and then rationalize the budget to make it fit. They set the budget, built the honest total cost model, and only fell in love with houses that genuinely fit within it. This discipline is harder than it sounds in the moment of falling in love with a property, harder in the moment of a seller accepting your offer, and the excitement of closing being real. The budget discipline that makes affordable homeownership sustainable is the same discipline that makes any long-term financial commitment sustainable. The decision made clearly and in advance before the emotional investment makes clear-eyed calculation difficult. They bought for life, not for Instagram. Here's the final characteristic that shows up in every sustainable, affordable homeownership story. The buyer bought a house they could actually live in and be happy in, not a house that would photograph beautifully or generate envy from their social circle. They bought for the school district that mattered to them, for the commute time that worked for their actual life, for the neighborhood that felt safe and welcoming and like a community they could belong to, for the floor plan that suited their family's actual habits, for the yard that their specific children would actually use. The buyers who struggle in affordable markets are often buyers who treated the purchase as primarily a financial decision, a bet on appreciation, a clever arbitrage, a cheapness maximizing exercise, and didn't adequately weight the lived experience of the home itself. A house you're strategically inhabiting is a very different daily experience from a house you chose because it fit your life. The latter supports well-being, relationship, community belonging, and the kind of contentment that makes a 30-year mortgage feel like a privilege rather than a constraint. Chapter 16. The Policy Landscape. What's changing and what needs to this video would be incomplete without at least acknowledging the larger policy environment that shapes who can access affordable housing and on what terms, because the individual buyer's situation doesn't exist in a vacuum. It exists within a set of policy choices that are actively being debated, changed and contested in ways that will affect affordable housing markets for years to come. Higher costs are impacting first-time homebuyers who are looking to enter the housing market. The relatively efficient system for people who are aging, growing, and later shrinking in the housing market has simply ground to a halt in many places. There is no single solution. However, for the first time in a long time, the focus is on municipalities, counties, and states to reform their land use policies, zoning policies, and entitlement requirements. Guardian Life. Zoning reform is the single most consequential policy lever available for improving housing affordability at scale. The supply of housing, which has lagged demand for over a decade, is restricted in ways that are primarily regulatory rather than physical. There is land. There is construction capacity. What there isn't, in many markets, is zoning permission to build the types and densities of housing that would close the supply gap. Single-family only zoning in high-demand areas prevents the construction of duplexes, triplexes, and small apartment buildings that would add supply without dramatically changing neighborhood character. Lengthy and expensive permitting processes add time and cost to every new home built. Minimum lot size requirements, setback requirements, and parking minimums make new construction more expensive than it needs to be. Several states, California, Oregon, Montana, and others, have passed statewide zoning reforms that override local single-family only restrictions and allow more housing types on more land. The early evidence from these reforms is cautiously encouraging. More housing is being built in the markets where restrictions have been loosened, and the additional supply is putting modest downward pressure on prices in some submarkets. This is the right direction. Whether it's happening fast enough to meaningfully affect the housing situations of people buying homes in 2026 is a harder question. The investor ownership debate deserves mention because it is live, contentious, and directly relevant to the competitive dynamics in affordable housing markets. Several states and cities have proposed or passed legislation restricting institutional purchases of single-family homes, requiring waiting periods before institutional buyers can bid, or outright limiting the number of single-family homes that large investors can own. The evidence on whether these restrictions actually improve affordability for individual buyers is mixed, but the political momentum behind them reflects real frustration with the competitive dynamics we described in Chapter 9. The down payment assistance landscape, as we've established, is robust and growing. The number of DPA programs increased 6% year over year to 2,619 as of Q4 2025. Kiplinger. But the funding and availability of these programs is not guaranteed. It depends on federal and state budget decisions, on housing agency priorities, and on the political environment in ways that can change meaningfully between administrations and legislative sessions. Buyers who are eligible for assistance programs should pursue them now, with the current program landscape, rather than assuming they'll be available on the same terms in the future. Chapter 17. The House Hacking Angle. How a $100,000 home can literally pay for itself. Here's a strategy that the most financially savvy buyers in affordable markets are deploying in 2026, and that transforms the $100,000 home from a housing expense into something closer to a wealth-generating machine. It's called house hacking, and if you haven't heard of it, get ready to have your mind mildly rearranged. The concept is simple enough to explain in one sentence. You buy a property, live in part of it, and rent out the rest to offset or eliminate your housing costs. The execution is more nuanced, but the core math is extraordinarily compelling, and in the $100,000 price range, it can produce financial outcomes that are genuinely difficult to replicate through any other strategy. Available to a first-time buyer, housing costs are taking up more of Americans' incomes than ever before, 21.4% for homeowners with mortgages. House hacking solves two problems at once. It reduces that percentage dramatically, and it lets you build equity in an investment property while your tenants help pay the mortgage. Yahoo Finance. Let's do the specific math on a $100,000 house hack, because the numbers are where this strategy goes from interesting concept to genuinely compelling opportunity. You purchase a 3-bedroom home in Cleveland, Detroit, or Birmingham for $95,000. After a 10% down payment of $9,500, you're financing $85,500 at 6.5% over 30 years, a monthly principal and interest payment of approximately $540. Add property taxes and insurance, and and you're at roughly $720 per month all in. You live in the master bedroom and rent the 2 remaining bedrooms. In most affordable Midwest and South markets, a private bedroom in a shared house rents for $400 to $600 per month. Let's use $450. Conservative, achievable, and realistic for the markets we've been discussing. 2 bedrooms at $450 each is $900 per month in rental income. Your $720 all-in monthly housing cost minus $900 in rental income equals negative $180. You are being paid $180 per month to live in your own home. You are building equity every month. You own an appreciating asset, and your effective housing cost is less than zero. Even in a scenario where you rent just 1 room at $450 per month, your effective housing cost drops to $270, significantly less than you'd pay to rent a single room in someone else's house in most of these markets. In 2026, house hacking is no longer about living for free. It's about making ownership workable. It's no longer about overnight wealth. It's about controlling housing costs, keeping cash invested elsewhere, and letting time do the work. The winners are buyers who treat it as a long-term housing strategy first, and an investment second. Carry. This recalibration of expectations is important. In the pandemic era of 2 to 3% mortgage rates, house hacking sometimes genuinely covered the entire mortgage. At 6.5% rates and 2026 home prices, even in affordable markets, it more typically covers a substantial portion of the mortgage rather than all of it. But even partial coverage is extraordinary. Reducing your monthly housing cost from $720 to $270 or from $720 to zero is not a marginal financial improvement. It is a transformative one that frees up cash for savings, for investment, for debt reduction, for building the financial position that enables the next move. The forms that house hacking takes in a $100,000 home vary by property type and personal situation. The most common is the room rental we just described, sharing common spaces like kitchen and living room with 1 or 2 tenants while each person has a private bedroom. This works particularly well when you're strategic about who you rent to. House hackers, specifically targeting travel nurses, graduate students, or young professionals who are frequently away or keep unconventional hours, experience less friction in shared spaces. Yahoo Finance, compatible personalities and clear house rules established in a formal written lease from day one make the shared living arrangement function smoothly. The short-term rental approach, listing a spare room on Airbnb or VRBO, can generate higher per-night income than a long-term tenant in the right markets. College towns during football season, cities with convention centers, tourist-adjacent communities. Before investing in this strategy, check 2025 to 2026 local ordinances, permit requirements, and any licensing fees. Violations can result in fines of $1,000 to $10,000 or more. Standard homeowners policies often exclude short-term rental activity. Contact your insurance agent before your first guest arrives. Ramsey Solutions. Short-term rental regulations have tightened significantly in many cities, and what's legal varies dramatically by location. Due diligence on the regulatory environment is not optional. It's the first step before incorporating any short-term rental income into your house hacking math. The ADU approach, adding an accessory dwelling unit, meaning a separate living space on the property, is more capital-intensive but potentially the most financially rewarding form of house hacking at the $100,000 price level. Many homes in the affordable Midwest and South have basements, garages, or lot sizes that could accommodate a separate unit. A finished basement apartment with its own entrance can rent for $600 to $900 per month as a truly independent unit, while maintaining complete separation between owner and tenant. No shared spaces, no roommate dynamics, a genuinely landlord-tenant rather than co-living arrangement. The cost of finishing a basement apartment, framing, plumbing, electrical, egress windows, runs $15,000 to $40,000 depending on the existing condition and scope. On a $100,000 home, that additional investment transforms a house into a small multifamily property with income-generating potential that dramatically changes the financial profile. Rental income can still help reduce housing costs, but it no longer defines the deal where rental income could easily cover the entire mortgage payment. In 2026, successful house hacking depends on strong credit, cash reserves, realistic rent assumptions, and treating the approach as a way to control housing expenses while building equity over time. Credible. For buyers who want to house hack but aren't sure they're comfortable with shared living, starting small is the right move. Rent a single spare room in your current home before committing to a multifamily purchase. This low-risk test drives the experience of collecting rent and managing a tenant relationship without the stakes of a major property purchase. What you learn in 6 months of room rental will inform your confidence in pursuing other house hacking strategies. Ramsey Solutions. The legal and practical requirements of being a landlord, even a small-scale one renting a spare bedroom, deserve direct acknowledgement. You need a written lease agreement. You need to understand your state's landlord-tenant laws regarding security deposits, notice requirements, and the eviction process if things go badly. You need to screen tenants, background check, credit check, reference verification before handing over a key. You need to treat the rental income as income for tax purposes and report it appropriately. None of this is overwhelmingly complicated, but all of it is genuinely necessary, and the buyers who skip these steps in the interest of casual simplicity tend to have the house hacking horror stories that make other people nervous about the strategy. The bottom line on house hacking in the $100,000 price range, it is the single most financially powerful use of an affordable home purchase available to a buyer who is comfortable with the shared living or landlord dimension. In markets where $100,000 buys a 3-bedroom house and rooms rent for $400 to $600 per month, the math can legitimately zero out your housing cost while you build equity, gain landlord experience, and position yourself for the next property purchase. It is the strategy most recommended by every serious real estate investor who started with limited capital and built a portfolio from the ground up, and it starts with a $100,000 house. Chapter 18, the 2026 market timing question: is now actually a good time to buy at this price point? We've spent this entire video on who can afford a $100,000 house. Let's spend this final chapter on a question that is implicit in everything we've discussed, but that deserves direct, data-driven treatment. Is 2026 actually a good time to buy in the affordable price range? Is this the moment? Are the conditions favorable? Or should buyers wait? The short answer, supported by everything the data is currently showing, is yes. 2026 is a meaningfully better buying environment than 2023 or 2024 for buyers in the affordable price range. And here's exactly why. First, the rate environment has improved. The Federal Reserve cut its benchmark federal funds rate by 0.25% 3 consecutive times in September, October, and December 2025, bringing it to its lowest level since 2022. The 30-year fixed mortgage rate averaged 6.18% as of late December 2025, and Realtor.com expects rates to average 6.3% in 2026, with the possibility of occasional dips below 6%. Empower, compared to the 7% plus environment of 2023 and much of 2024, 6.3% rates meaningfully reduce the monthly payment on an $80,000 loan, saving approximately $55 to $65 per month compared to a 7.5% rate. Over 30 years, that's $19,000 to $23,000 in interest savings. Not dramatic in absolute terms, but real money. Second, income. Growth is outpacing home price growth for the first time in years. 2026 will mark the beginning of a long, slow recovery for the housing market, the Great Housing Reset. It won't be a quick price correction, and it won't be a recession. Instead, it will be a years-long period of gradual increases in home sales and normalization of prices as affordability gradually improves. Incomes are expected to rise faster than home prices for a prolonged period, for the first time since the aftermath of the financial crisis. Empower. When incomes grow faster than home prices, the effective affordability of every home improves, not because the sticker price fell, but because you can afford more of it. For buyers in the $100,000 price range, this dynamic means the home that costs $840 per month today will represent a smaller share of your income in 2 years than it does right now. Third, the Midwest and the primary geography of $100,000 homes is the region forecast to see the strongest housing market performance in 2026. Price growth will vary by region, with the strongest growth expected in the Midwest and New England. Midwestern cities like Jackson, Michigan, and Rockford, Illinois are seeing stronger than average price momentum. Columbus, Ohio, Indianapolis, and Kansas City are showing outsized growth, Fox Business, and states like Illinois are seeing annual home price appreciation of 5.4%, far outperforming the cooling national average. The Motley Fool. This is the key insight for the $100,000 buyer in 2026. The geography where these homes are concentrated is the geography that housing economists are most bullish about for 2026 performance. The Midwest is the winner's geography in the current market forecast. The affordable Midwest home you buy in early 2026 is, according to multiple data sources, likely to appreciate more than the national average this year, not despite being in an affordable market, but partly because of it. Toledo, Ohio, with a median list price near $199,900, is projected to see price growth of 13.1%. This tells real estate analysts that the price point is so incredibly low that even minor competition dramatically boosts the percentage appreciation. Toledo is a pure affordability play. Guardian Life. If Toledo at $200,000 is generating 13% projected appreciation from the affordability dynamic, the same logic applies with even greater force to markets at $100,000. Fourth, inventory is rising, which means buyers have more options and less panic-inducing competition than in the 2021 to 2022 peak. Inventory is forecast to continue rising in 2026 by about 10%, according to both Realtor.com and Bright MLS. More available homes help reduce buyer competition and can also help keep price growth in check, improving affordability for would-be buyers. CBS News. In affordable markets specifically, more inventory means you can take a breath between listings, make offers with inspection contingencies rather than desperate waiver of everything. Offers and find the right property rather than buying whatever doesn't get snatched first. Fifth, and perhaps most importantly for the long-term buyer, the Midwest and Great Lakes regions have wide appeal because they're fairly affordable and provide relatively safe havens against climate risk. Empower. As climate-related costs, insurance, disaster risk, extreme heat increasingly shape the total cost of homeownership in coastal and Sunbelt markets, the Midwest's climate stability is becoming a genuine competitive advantage in ways that weren't part of the housing conversation 5 years ago. Florida insurance premiums are catastrophically high and rising. Parts of Texas face increasing heat-related livability questions. The Midwest, for all the jokes about its weather, is beginning to look like the climate-stable, insurance-affordable, habitability-secure region that housing economists are quietly starting to call the future of American homeownership. The case for waiting, for holding off on the $100,000 purchase in hopes of better conditions, is weak in 2026 for a specific reason. The prices in affordable markets are already moving. From a national perspective, we can expect a moderate increase in prices of plus 3% year over year, with the strongest growth expected in the Midwest. Fox Business. On a $100,000 home, 3% appreciation is $3,000. On a 10% down payment of $10,000, that's a 30% return on invested capital in a single year, before you've lived in the home, before any rental income from house hacking, before any equity you've built through mortgage payments. The home you can buy for $95,000 today in Rockford or Cleveland might be $100,000 or $105,000 by the time you've spent another year waiting for the right moment. The right moment is when you're prepared, not when conditions are perfect. The American dream is still alive. The desire for home ownership has not fallen. Many renters say that if the conditions are right, they would like to become homeowners. The past couple of years have been frustrating because of elevated mortgage rates, but things will be much better to achieve that American dream of ownership in 2026, with more inventory choices and mortgage rates falling. Kiplinger. The $100,000 home buyer in 2026 is entering a market that is tilting, modestly but measurably, in their favor. Rates are lower than they were, inventory is higher than it was, income growth is outpacing price growth. The Midwest markets where these homes are concentrated are the ones forecast to appreciate most strongly this year. The assistance programs are more numerous and better funded than at any prior point. The house hacking strategies are proven and deployable, and the competition, while real from investors, is more navigable than at the peak of the 2021 to 2022 frenzy. The conditions are not perfect. They may never be perfect, but they are right now in 2026 genuinely favorable for the prepared, informed, financially positioned buyer who has done the work this video has described. The window is open. The question is whether you walk through it. Chapter 19, The Mindset Shift, Stopping the Wait and Starting the Walk. Here's the final thing that needs to be said about who can afford a $100,000 house in 2026. And it has nothing to do with income thresholds, credit scores, debt-to-income ratios, or down payment assistance programs. It has to do with something that is simultaneously softer and more consequential than any of those financial metrics: the way people think about what is possible for them. Because here's what the data shows, and what every housing counselor, every mortgage professional, every real estate agent working in affordable markets will tell you from direct experience. The single largest barrier between most people and a $100,000 home is not money, it's belief. Or more specifically, it's the absence of belief, the quiet, persistent, rarely examined conviction that home ownership is for other people. People with more money, people with better backgrounds, people who somehow figured something out that you haven't. People who got lucky, or got help, or were born into circumstances that made the path easier. This conviction is understandable. It has been built over years by a housing market narrative that focuses almost exclusively on the expensive end, on the $800,000 starter home in Austin, on the bidding wars in Seattle, on the Manhattan one-bedroom that costs more than a small country. That narrative, repeated endlessly in media coverage of housing, creates a cultural sense that homeownership in 2026 is an elite aspiration rather than an accessible milestone. And for a significant portion of the population, particularly younger adults who came of age during the post-2008 housing market, the sense of exclusion has calcified into an assumption that is rarely questioned and almost never tested against actual data. When you test it against actual data, which is what this entire video has been doing, the assumption doesn't hold. The threshold income for a $100,000 mortgage is $28,000. The down payment with FHA is $3,500. The average DPA program benefit is $18,000. The median home price in Decatur, Illinois is $89,000. The monthly payment on an $80,000 loan at 6.5% is $506. These are not numbers that describe an elite aspiration. They describe an accessible reality for a specific buyer in a specific geography with specific preparation. Not for everyone, not without effort, not without honest assessment of individual circumstances, but for a much broader population than the housing narrative suggests. The mindset shift required to access that reality has several specific components, each of which is worth naming clearly. From "can I afford it" to "what would I need to afford it?" Most people ask the wrong first question. Can I afford a home is a question that invites a yes or no answer, and for many people in their current financial situation, the honest answer is no, which they already knew, which confirms the sense of exclusion, and which produces no useful information about what would change the answer. The better question is, what specific changes to my financial situation would make a $100,000 home affordable for me? This question has a specific actionable answer. It might be, raise my credit score from 580 to 640, which I can do in 12 months of consistent on-time payments and credit utilization management. It might be, save $8,000 for down payment and closing costs, which at $667 per month will take 12 months. It might be, pay down my car loan from $450 per month to $200 per month by the time I apply, which I can do with aggressive extra payments over 18 months. These are specific, time-bounded, achievable targets. They transform "can I afford it?" from a discouraging yes/no into a project with milestones and a completion date. The buyers who successfully purchase affordable homes almost universally report that they spend a specific period, often 12 to 24 months, working on a specific list of financial improvements that they had identified as the gap between where they were and where they needed to be. They didn't wait to feel ready. They defined what ready meant, and they worked toward it. From someday to by when. Someday I want to own a home is not a plan, it is a wish. And wishes, without conversion into plans, have a remarkable tendency to remain unfulfilled indefinitely, not because the person doesn't want it, but because someday creates no urgency, no deadline, no accountability, and no framework for the daily decisions that determine whether the goal is approached or perpetually deferred. People who set specific target dates for major financial goals are significantly more likely to achieve them than people who hold the same goals without target dates. The goal functions as a commitment device, something that organizes present behavior around a future outcome in a way that vague aspiration cannot. Fred, I want to own a home by June 2027 is a plan. It is a statement that creates a 20-month timeline, which can be worked backward into quarterly milestones, monthly targets, and weekly behaviors. By June 2027, I need a credit score of 650 or above, $12,000 in savings, a DTI ratio below 43%, and a market selected and researched. Each of those targets has a path. Each path has steps. The steps are the daily and weekly decisions, the extra payment toward the credit card, the automatic transfer to the savings account, the Saturday afternoon spent reading about housing markets in the 3 cities you're considering. The target date makes all of those decisions make sense. Someday makes them feel optional. From I can't compete to I know how to compete. The sense of competitive disadvantage, of being a regular buyer trying to compete against cash investors and well-resourced purchasers, is real and discouraging and often used as a reason to disengage from the home purchase process entirely. The deck is stacked. The investors will win. I don't have a chance. This is both partly true and completely unhelpful. Yes, cash buyers have structural advantages. Yes, investors are active in affordable markets. Yes, a well-priced property in good condition will sell quickly and may attract multiple offers. All of this is true. None of it means that an individual owner-occupant buyer cannot purchase a $100,000 home. It means they need to be prepared to compete, and preparation, in the home buying context, is entirely within the buyer's control. Being a prepared buyer means having a pre-approval letter in hand before you start shopping, knowing your numbers cold, having your agent relationship established in advance, and being ready to move on a property within 24 to 48 hours of seeing it, because the good ones move that. Fast in affordable markets. Bank rate. It means having seen enough properties in your target market that when the right one appears, you recognize it immediately, rather than needing 3 more visits to decide. It means having done enough due diligence on your own financial situation that no question from an underwriter will catch you off guard. The prepared owner-occupant buyer is not helpless against investor competition. They are different from the investor in one specific way that sometimes matters to sellers. They're going to live there. In some transactions, particularly with individual sellers who have an emotional relationship with the property and prefer it to go to a family rather than a landlord, this difference is meaningful. It's not leverage in every deal, but it's leverage in some deals, and the prepared buyer knows when to use it and how. From it's not the right time to I'm not ready yet, but here's when I will be. The most seductive version of housing. In action is the market timing rationale. Rates are too high. Prices are too elevated. The market is going to correct. Now isn't the right time. I'll wait until things settle down. This rationale has been continuously available as a justification for not buying since roughly 2012, when the post-crisis recovery began. Buyers who used it in 2012 missed markets that then appreciated 40% over the next 5 years. Buyers who used it in 2017 missed the pre-pandemic appreciation. Buyers who used it in 2020, there's a pandemic, this isn't the time, missed the most extraordinary appreciation in modern American housing history. The market timing rationale is always available. It is almost never correct as a reason to indefinitely defer a purchase that your financial situation actually supports. This is not an argument for buying when you're not financially ready. That's a different and equally important point. The argument is specifically about using market timing as a reason to defer when the actual issue is financial preparation. If your credit score is 590 and you don't have a down payment, the reason not to buy right now is not the market. It's your financial readiness. Fix the financial readiness and revisit the market. If your financial readiness is solid and you're deferring because you think rates will fall another point in the next year, the data suggests that the appreciation in your target market during that year will cost you more than the rate improvement will save you. Time in the market almost always beats timing the market when it comes to real estate. The buyers who are best served by waiting are those who need more time to prepare, not those who are financially ready but intellectually convinced that conditions will improve. Empower the final word on belief. Here's what this video has ultimately been about. Underneath all the data and the chapter headings and the specific numbers, it has been about expanding what people believe is possible for them in the American housing market. Because belief precedes action, always. You cannot pursue a goal you don't believe is achievable. You cannot prepare for a purchase you don't think is realistic. You cannot move to a market you've written off as beneath you or irrelevant to your life. The statistical and financial case for the $100,000 home is real and well supported, but the statistical and financial case matters nothing if the person reading it has already decided at some level below conscious articulation that homeownership is simply not in the cards for them. The data says otherwise. The $100,000 home says otherwise. The $2,619 down payment assistance programs say otherwise. The $28,000 income threshold says otherwise. The nurse in Cleveland who bought a 3-bedroom house last year for $87,000 and rents 2 rooms for $450 each says otherwise. The remote worker in Birmingham who sold their San Francisco apartment, bought a 4-bedroom house with a yard for $98,000 and now has a mortgage payment lower than their old utility bill says otherwise. The retired teacher in Decatur who bought her first home at 63 with a combination of Social Security, a small pension, and a state assistance program says otherwise. These people are not special cases. They are not extraordinarily lucky. They are not operating under uniquely favorable circumstances that you lack. They are people who decided to take the question seriously, did the preparation work, and then bought a house. In a market where the median price was under $100,000, with a monthly payment that left them financial breathing room they'd never previously experienced. In a community that, whatever its limitations relative to the coastal metros of popular imagination, offered them a home, an actual, owned, yours until you say otherwise home, in a way that renting never had. That is what a $100,000 house offers in 2026. Not perfection, not glamour, not the Instagram-worthy kitchen. Renovation or the walkable neighborhood full of artisan coffee shops. A home with equity that builds every month, with a payment that doesn't increase every time the landlord decides it should, with a yard, maybe, or at least a door you can paint whatever color you want without asking permission. The question was, who can actually afford it? The answer is, more people than know it, possibly including you. The next question is yours to answer. Conclusion, so, who can actually afford it? We started this video with a simple question and spent a lot of time getting to an honest answer. So let's state it clearly and directly. Who can actually afford a $100,000 house in 2026? Local workers in affordable markets earning $28,000 or more annually with manageable debt, a 620 plus credit score, and $8,000 to $15,000 in savings can genuinely afford it. With the right preparation, the right programs, and the right property selected with eyes open to condition and true ownership cost. Remote workers earning coastal salaries who are willing to relocate can afford it with extraordinary financial comfort. The math is nearly embarrassingly favorable for someone earning $70,000 to $100,000 in markets where the median home price is under $100,000. Retirees with Social Security plus supplemental income at or above $35,000 annually can afford it, particularly with a cash purchase using equity from a previously sold home, making it one of the cleanest wealth preservation strategies available in the current economic environment. First-time buyers who do the preparation work, who spend 12 to 24 months improving their credit, reducing debt, building savings, and researching assistance programs, can access these homes even on modest incomes, particularly with the DPA programs that can contribute an average of $18,000 toward the purchase. And investors, cash buyers, individual and institutional, can absolutely afford it, and they do in large numbers, which creates competition that prepared owner-occupant buyers can navigate with speed, pre-approval, and the right local professional relationships. Who genuinely cannot afford it at least not yet, is the person with significant credit damage, high existing debt that consumes most of their income capacity, no savings for down payment or closing costs, and no access to or awareness of assistance programs. Not because the dream is wrong, but because the financial foundation isn't there yet. The prescription for this buyer isn't despair. It's the 12 to 24 month preparation plan, credit repair, debt reduction, savings building, program identification. The $100,000 home doesn't disappear from the landscape while you spend a year and a half getting financially ready for it. The affordable housing markets, by definition, move more slowly than hot coastal markets. The preparation time is available to use. Here's the most important thing this video has been building toward: the $100,000. House is not a consolation prize. It is not where people end up when they couldn't afford a real house. It is, for a specific set of buyers in a specific set of circumstances, the smartest housing decision available in the 2026 market, offering a monthly payment that frees up financial capacity for everything else that matters in a financial life, an equity-building opportunity in markets where appreciation is possible, and a quality of life that, in terms of space, community, and actual daily experience, competes favorably with what vastly more expensive housing in premium markets offers. Mortgage rates have slowly declined throughout 2025, with the average 30-year fixed mortgage rate falling from a peak of 7.04% in January to an average of just under 6% in late December. And there's a chance that mortgage rates could fall further in 2026, easing things even further for buyers. Kiplinger. The window of combination, rates declining, affordable inventory still existing, DPA, programs well-funded and numerous, is open right now. The buyers who prepare seriously and move strategically will find it. The buyers who wait for conditions to be perfect will find that perfect is the enemy of good, and that the house they could have bought in 2026 is worth $115,000 by the time they feel ready, get pre-approved, research the market deeply, fix what needs fixing in your financial profile, find the assistance programs you qualify for, hire a local agent who knows the affordable inventory in your target market, get the inspection, budget honestly for the total cost, and then buy the house. The $100,000 house exists. The path to owning it is real. The life on the other side of that purchase, with a mortgage payment lower than most people's rent, in a community that may surprise you with what it offers, is genuinely available to a much broader population than the national housing conversation suggests. You just have to know what you're doing, and now you do.